All right, welcome to The Explainer. Today we're doing something really cool. We're going to crack open that black box. You know the one, quantitative trading. For a long time, this was the exclusive playground of giant hedge funds with PhDs in physics, but not anymore. We're going to break down how you, a regular investor, can start thinking and acting like a quant, using data to drive your decisions.
Okay, so here's the game plan. First, we'll talk about the huge mental shift you have to make, moving away from gut feelings to a real system. Then, we'll get practical with 3 strategies you can actually use. After that, we'll look at the tools of the trade, what you need in your toolkit, and we'll wrap up with the big one, how to avoid the mistakes that trip up almost everyone. Sound good? Let's dive in.
All right, first things first. Before we get into any of the cool stuff like strategies or code, we got to talk about the foundation. It's all about rewiring your brain and shifting how you approach the market. So look at this. On one side, you've got what most people do, right? Discretionary trading. You hear a tip, you read some news, you have a good feeling about a stock. It's all based on intuition. It's subjective. Now, on the other side, you have the quant approach, systematic trading. Here, everything, and I mean everything, is based on a predefined set of rules. It's all about data and backtesting. You're not trying to be a hero and pick the one magic stock. Nope. Your goal is to build a winning system, a machine that has a small edge and can apply it over and over and over again.
And why bother with all this? Why go through the trouble of building a system? Well, Dr. Alex Rivera puts it perfectly. The whole point is to eliminate or at least control our own behavioral biases. Let's be honest, we are our own worst enemies when it comes to investing. We get greedy when things are going up, we panic and sell at the bottom. A system doesn't have emotions. It just follows the rules. It becomes your shield against making those classic fear and greed-driven mistakes that wreck most portfolios.
Now, this is something I find fascinating, and it's a point a lot of people just don't get. You might think, how can I possibly compete with a multi-billion-dollar hedge fund? Well, you actually have a few secret weapons. First, you're small, and that's a good thing. A giant fund can't buy a small, illiquid stock without sending the price to the moon. You can. You have flexibility. Second, you're agile. You don't have a board of directors or an investment committee breathing down your neck. If you want to change something, you just do it. And that means you can explore unique niche strategies that are too small or too weird for the big institutions to even bother with. That's your edge.
Okay, theory time is over. Let's get into the good stuff. We're going to look at 3 concrete, actionable strategies. These aren't some crazy high-frequency trading things. These are classic, well-researched ideas that you can actually understand and start to explore on your own. All right, first up we have momentum. This is maybe the heavyweight champion of quant factors. The idea is so simple it almost sounds, well, too simple. It's the riding the wave strategy. The core belief is that things in motion tend to stay in motion. Stocks that have been going up strongly are likely to keep going up, at least for a little while. Your job is just to find those waves and hang on.
So how do you actually do this? Dr. Lena Petrova shared a really simple recipe with us. Step 1, you define your universe. You got to decide what stocks you're even looking at. Let's say the S&P 500. Step 2, you rank them. You look at every single one of those 500 stocks and calculate its performance over the last, say, 3 to 12 months. Who's been the strongest? Step 3, you form your portfolio. You just buy the top performers, maybe the top 10%, so the top 50 stocks. And step 4, this is absolutely crucial, you rebalance. Every month, you run the process again, you sell the ones that have fallen out of the top group and buy the new leaders. It's a constant process of pruning the losers and adding the winners.
Okay, so what's the catch? Because there's always a catch. On the plus side, momentum is pretty easy to understand, and the historical data backing it up is, well, it's massive. It's one of the most robust factors ever discovered. But, and this is a huge but, when it's wrong, it's spectacularly wrong. Momentum can and does experience these violent crashes. When the market suddenly pivots, like it did in 2009, all those high-flying stocks can fall off a cliff together. Sticking with this strategy means you have to be prepared to endure some really painful drawdowns. It takes guts.
All right, strategy number 2 is basically the polar opposite of momentum. It's called mean reversion. The idea here is that prices are kind of like a rubber band. When they get stretched too far in one direction, they tend to snap back to the average. So instead of buying what's going up, you're actively looking for things that have been beaten down, and you're buying them, betting on that quick bounce back. The recipe for this is all about being a short-term bargain hunter. You define your universe of stocks, and then you're hunting for a very specific signal. A stock that's just had a really bad week, for example. Maybe it dropped 10% in 5 days. You don't just buy one, though. You buy a whole basket of these oversold stocks.
And here's the key. You don't plan on holding them for long. You're looking for a quick pop over the next few days. You get in, you grab a small profit, and you get out. It's a fast-paced game.
So what's the good and the bad here? Well, the good part is that it can feel very satisfying. You get these frequent small wins. It feels like you're a savvy investor buying the dip. The downside? First, transaction costs. You're trading a lot, and those commissions and fees can chew up your profits fast. But the real terrifying risk is something called catching a falling knife. Sometimes a stock is down 10% for a very, very good reason, like they're about to go bankrupt. You buy it thinking it'll bounce, but it just keeps falling. That's how you can lose a lot of money fast. Okay, our third and final strategy is quantitative value. Think of this as Warren Buffett, but turned into an algorithm. You know the classic advice, buy good companies at a cheap price. Well, this takes that philosophy and makes it systematic. Instead of subjectively deciding what's good or cheap, you use hard financial data and rules to do the work for you.
So how does the recipe work? It's actually a really elegant two-part system. First, you look for cheapness. You rank all the stocks in your universe on a valuation metric, like earnings yield. Basically, how much profit are you getting for the price you pay? Second, you look for quality. You rank all those same stocks again, but this time on a metric like return on capital. How good is the company at generating profits from its assets? Then you just combine the two ranks. You're looking for the stocks that are in the sweet spot, high quality and a cheap price. You buy a basket of the top 20 or 30, and then you wait. This is a slow and steady strategy. You hold them for a whole year before you rebalance.
This brings us to the biggest challenge with value. The pros are huge. It's a disciplined, long-term approach that has worked amazingly well over decades. It's also low turnover, so it's tax efficient. The con? It's one word: patience. This strategy can go through brutal periods of underperformance. I'm talking years. Imagine watching all your friends get rich on flashy tech stocks while your portfolio of cheap industrial companies is going nowhere. It is psychologically agonizing. Sticking with this requires an almost superhuman level of patience and conviction in your system.
All right, so we've covered the mindset and a few core strategies. Now for the nuts and bolts. What do you actually need to get started? Let's open up the Retail Quant Toolkit.
First and foremost, you need data. Everything in the quant world is built on data. And the good news is, you don't have to break the bank to start. There are fantastic free resources out there, like the Y Finance library for Python, that can pull data right from Yahoo Finance. As you get more serious, you might want to look at paid, professional-grade data. But here's the non-negotiable part. Your data has to be clean. It must be adjusted for things like stock splits and dividends. If it's not, your backtests will be complete garbage. Garbage in, garbage out.
Okay, you've got your data. Now where do you analyze it? You have options here, and you do not have to be a programming genius to start. Dr. Petrova mentioned that you can learn a ton just by messing around in Excel or Google Sheets. It's a great way to understand the mechanics. But if you're serious, the industry gold standard is Python. The libraries it has for data analysis are just unmatched. And if you want something that does a lot of the heavy lifting for you, there are these amazing all-in-one platforms like Quant, where you can research, backtest, and even live trade your algorithms all in one place.
Listen up, because this is where dreams go to die if you're not careful. Backtesting. This is how you find out if your brilliant idea is actually any good. But you have to be absolutely brutal with yourself. A sloppy backtest is worse than no backtest at all. You must include realistic costs for commissions and slippage. You must test your idea on data it wasn't built on. That's called out-of-sample testing. And for the love of all that is holy, do not just look at the final return number. You have to look at the risk. What was the maximum drawdown? How much would you have lost from the peak? Because that's the number that tells you if you'd actually be able to sleep at night while trading this thing for real.
Okay, we're heading into the home stretch, and this might be the most valuable section of all. We're talking about the traps, the pitfalls, the landmines that blow up, according to Dr. Rivera, something like 90% of all retail quant journeys.
So what is it? What's the number one killer? You might think it's just coming up with a bad strategy, but honestly, it's usually not that. The real failure point is often something deeper. Well, the data shows that for most retail traders, it's just bad risk management. Plain and simple. Betting the farm on a single trade. But for people like us, people trying to build systems, there's another trap, one that's way more subtle, and maybe even more dangerous.
And here it is, the cardinal sin of quantitative trading, overfitting. Imagine you're tailoring a suit, but instead of fitting it to a person, you fit it perfectly to a mannequin. It looks incredible on the mannequin. Every curve is perfect. But the moment a real person tries to wear it, it rips apart, because real people move. Overfitting is just like that. You tweak and tune your strategy with more and more rules until it perfectly fits the past data. It looks amazing in the backtest, but you haven't found a real signal. You've just perfectly modeled the random noise of the past, and it is absolutely guaranteed to fail in the real world.
So, when you boil it all down, what's the secret? Well, Dr. Petrova said it best. There is no secret. There's no magic formula. It's a marathon, not a sprint. The real, lasting edge doesn't come from a flash of genius. It comes from discipline, from rigor, from having a solid process, and sticking to it day in and day out over the long haul.
And that brings us to the final and, I think, the most profound question of all. It has nothing to do with Python code or data feeds. It has to do with you. See, the whole point of this exercise of building a system is to take your emotions out of the driver's seat. The system is designed to be disciplined, but what happens when that system is in a drawdown for 6, 7, 8 months straight, and every fiber of your being is screaming at you to just do something, to override the system just this once? Well, you have the discipline to stick to the plan. You can build a disciplined system. The real question is, are you disciplined enough to follow it?